Hello, I'm JS Kim with Smart Knowledge U. Given the great imminent risks in today's investment environment, gold and its many investment forms is one of the best investment vehicles today despite its stigma as a speculative asset. This stigma is largely one created by the commercial investment industry due to the fact that investments in commodities draws money away from investments in stocks and thus cuts into their profit margins. Gold's speculative stigma is not only largely undeserved, but is pure propaganda fueled by the interests of the commercial investment industry. Gold is one of the most misunderstood asset classes of all time. Not only does the commercial investment industry continually deceive you, but the US Fed Reserve actively participates in this deception as well. Let's consider the comment above. This is the shabby secret of the welfare status tirades against gold. Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. It stands as a protector of property rights. If one grasps this, one has no difficulty in understanding the status antagonism toward the gold standard. Who made this comment? It sounds like an avid gold bug conspiracy theorist, right? Wrong. Former chairman of the Federal Reserve, Alan Greenspan. Only he made this comment in 1966, a couple decades before he would become chairman. Let's look at another comment. The Fed succeeded. It stopped the gold loss, but it nearly destroyed the economies of the world in the process. Again, this comment was made by former US Fed Reserve Chairman Alan Greenspan in 1966. He made that above comment in regards to the Great Depression that happened in 1929. When business in the US underwent a mild contraction in 1927, the Federal Reserve created more paper reserves in the hope of forestalling any possible bank reserve shortage. More disastrous, however, was the Fed's attempt to assist Great Britain, who had been losing gold to the US because the Bank of England refused to allow interest rates to rise when market forces dictated it. They refused to allow interest rates to rise because at that time was politically unpalatable. The reasoning of the authorities involved was as follows. If the Fed Reserve pumped excessive paper reserves into American banks, interest rates in the US would fall to a level comparable with those in Great Britain. This would stop Britain's gold loss and avoid the political embarrassment of having to raise interest rates. However, the excess credit which the Fed pumped into the US economy spilled over into the stock market and triggered a fantastic speculative boom. By the time the Feds attempted to clean up this mess, the speculative stock market bubble had collapsed and the Great Depression had begun. Lastly, let's look at one final comment. This also was made by former US Fed Reserve Chairman Alan Greenspan, but more recently in 1998. He stated, quote-unquote, "Central banks stand ready to lease gold in increasing quantities should the price rise." Now, he made this comment in congressional testimony before the Senate Finance Committee. And he also made this comment in response to questions from senators about huge multi-billion-dollar futures bets being made by the biggest firms on Wall Street. In essence, these firms were betting that the price of gold would continue to go down. If the price of gold reversed and climbed higher, basically many Wall Street firms would stand at the brink of bankruptcy. So in essence, we see from the above comment, even though the Fed Reserve vehemently denies ever manipulating gold markets or stock markets for that matter, Alan Greenspan testified before US Congress that the Fed Reserve would intervene and reverse free market behavior in the gold markets if necessary to guarantee huge profits for Wall Street. Now let's look at some of the erroneous gold myths spread by commercial investment firms. Gold is dangerous because it is volatile. Certainly, if we look at this chart, which is a condensed period of 14 months, we see huge volatility in gold stocks. However, if we take a longer-term view, we see that this huge volatility is basically just a consolidation channel, where it is moving between a floor and a ceiling. So if we take a longer-term view, it's a classic picture of the wall of worry in a continued bull market. Another gold myth, gold is too difficult to understand, so it's risky. And finally, gold is too expensive. We have to wait until it corrects to $800 an ounce or so before we'll invest. Now, interestingly enough, this gold bull run began at about $250 an ounce. People said gold was too expensive at $300 an ounce, $400 an ounce, $500, $600, $700, $800, $900, and even $1,000 an ounce. You must understand what is driving gold's price higher. If you do, you will understand its worth, and you will understand that even at $900 an ounce, one day you will look back at this price and remark at how cheap gold once was. Finally, let's look at the price of the all-time high from the last gold bull market. That happened in September 21st, 1980, when gold was trading at about $850 an ounce. If we adjust this $850 from 1980 on an inflation-adjusted basis, today that $850 would be worth more than $2,400. People claim to use that $850 figure is erroneous and a poor argument, because it was a one-off event triggered by the Yom Kippur War and oil embargo and crazy interest rates instituted by then U.S. Fed Reserve Chairman Paul Volcker. I maintain that to use that 1980 price of $850 an ounce and the inflation-adjusted price of $2,400 an ounce is valid because of the fact that the dollar crisis we face today is even greater than the crisis the world faced back then. So there are two maxims that will help you profit from this gold boom. Number one, after hydrogen, stupidity is the next most common element in the universe. Albert Einstein. Stupidity will help because it always creates volatility in precious metal markets. Thus, there will always be opportunities to buy even as this bull market plunges forward. Number two, the only risk in investing comes from not knowing what you are doing. Legendary investor Warren Buffett. Not knowing what you're doing often causes many people to fear the wrong thing. They fear a commodity bubble instead of fearing a speculative stock market bubble created by the easy money policy of the US Fed Reserve. However, know what you're doing and you'll know where to make money in these markets. Now, even today, with gold making a spectacular run from $250 an ounce all the way up to over $1,000 an ounce, investors simply still do not understand gold as an asset class. In 2000, the worst 3 years of the US stock market since the Great Depression began. Now, this pie chart here represents the US stock market. How much do you believe of this entire US stock market in 2000 was invested in gold? Well, here's the answer. Only 1% of all stocks. There are many ways to invest in gold. As you can see from this list here, the gold coins, gold bullion, gold exchange traded funds, certificates, futures contracts, land companies, gold mutual funds, development, exploration, and production companies. Exchange traded funds, by the way, are the equivalent of the diversification strategy. It's one of the easiest ways, but far from one of the best.